I used to dollar cost average, euro cost average into my ETFs, but I stopped doing that. Today I'll show you why and what I do instead, backed by long-term historical data. Something you may be surprised to hear, since dollar cost averaging is often treated as the holy grail of long-term investing by many investors online. But does it actually reduce risk, or is it giving you a false sense of security? You'll also find out why most people who think they're DCAing aren't actually doing so. This may include you as well. If you're new here, my name is Angelo, and I've been investing in low-cost ETFs for over 8 years with my wife, with the goal of being able to retire early in a few years if things go well. Let's start with the biggest misconception about dollar cost averaging. Each time you're investing 100 or 1000 euros from your monthly paycheck into ETFs, you probably think you're dollar cost averaging. I've got news for you, you're not. What dollar cost averaging truly means is having a lump sum, so an amount of cash sitting on your account you plan to invest, and deliberately choosing to spread it out over time instead of investing it all at once. Let's say you inherit 120,000 euros today. If you invest 10,000 euros a month over the next year, that's a DCA strategy. This also applies if you spread it out over shorter periods like 3 or 6 months. But investing what you're able to save from a monthly salary as it comes in, that's not DCA, that's just investing when you have money. You could call it periodic lump sum investing, because you're actually investing everything as soon as you get paid. You're not holding anything back on purpose. It's true that you're averaging out your ETF share price by buying on a monthly basis, but the important distinction is that you're not doing so deliberately. But wait, doesn't a DCA strategy reduce your risk? Well, here's what nobody tells you about dollar cost averaging. It doesn't actually protect you from crashes. In fact, you could end up with the worst possible combination: a higher average purchase price and the same full exposure to the downturn when the market corrects or crashes. Take a simple example. Imagine you received a 120,000 euro inheritance in January 2021. Being prudent, you decide to invest 10,000 euros monthly into the Vanguard FTSE World for a year. Here's what happened. January, the share price is around 81 euros. Your 10,000 euros buys 123 shares. December, the share price is around 100 euros. Your 10,000 euros now buy only 100 shares. The average price you paid throughout that year is 91.85 euros for a total of 1,307 shares. And your portfolio value at the end of 2021, with a share price of over 104 euros, is 136,306 euros. Then 2022 happens and the market falls 13.01%. Your portfolio drops to 118,563 euros. So you're down 1,437 euros overall. Now let's see what would have happened if you had invested everything immediately in January 2021 at 81.39 euros per share. You get 1,474 shares right away. Your portfolio value at the end of 2021 is 153,837 euros, and you experience the same 13% correction in 2022. Your portfolio falls to 133,820 euros, so you're still up 13,820 euros overall, and plus 15,257 euros compared to the DCA investor, despite experiencing the same drawdown in 2022. So basically, the cautious DCA investor spent the entire year averaging up, so buying fewer and fewer shares as the prices rose. But when the crash finally came, they lost the same percentage as everyone else, just from a worse starting position. Of course, you will find moments where cost averaging would have performed better in comparison, like in 2020, the year of the COVID crash. Since the crash happened in the first quarter of the year and price only recovered by mid-November, a DCA investor performed better during this period, but only by around 5,700 euros, so only a minimal difference considering a 120,000 euro investment amount. Had the crash happened in August or towards the end of the year instead of March, then a lump sum investor would have been better off. So even in crash years, dollar cost averaging doesn't actually guarantee better results, as you need the crash or correction to happen at exactly the right time in your schedule, something that's sadly impossible to predict. Now, while it may feel like you're playing it safe when you spread out your investment instead of buying everything at once, let's see what the data actually shows for a world ETF. Since 1979, 65% of the months had positive returns, so 2 out of 3. And on a yearly basis, we're looking at 74% positive returns historically. That's 3 out of 4 years. Of course, nobody can predict the future, but it's clear that based on history, the market trends upwards over time. When you DCA, you're essentially betting against this trend. You are statistically more likely to underperform by waiting compared to investing everything at once. As the old saying goes, time in the market beats timing the market. Speaking of time in the market, you can find my favorite low-cost broker to get started with ETF investing linked down below, which is a great way to support me if you'd like to. Now, will there be dips, corrections, or even crashes along the way? Of course, but they're impossible to predict and they shouldn't factor into your decision making if you're investing for a long run, so for 10 years or more. But what if I invest right at the peak? Fair question. Yes, DCA can beat lump sum if you invest at the very unlucky top, right before the market tanks. That's a scenario everyone is afraid of. But here's the thing, even in a worst case scenario, it's not as bad as you think. Take the worst possible timing in recent history, investing everything right before the 2008 financial crisis. If you had put 100,000 euros into the MSCI All Country World in October 2007, just before the crash, you would have been down as much as minus 48% by February 2009. Brutal, right? Well, if you held on, you would have been back in positive territory by late 2012, and now your investment will be worth over 424,000 euros. That's despite entering at literally the worst possible moment in the last 2 decades. Meanwhile, while you're DCAing to avoid that small risk of bad timing, you're guaranteed to miss some dividends, guaranteed to miss the average market growth on cash sitting in the bank, and guaranteed to pay with your time and attention. Even bad timing beats perfect DCA timing more often than not. But even understanding this, you might still wonder how much this really matters for your situation, so let me share the mental model that changed how I think about lump sum investing. Ask yourself this simple question: is the amount you're worried about investing all at once actually a large percentage of your lifetime investments? Say you're 30 years old, planning to invest 1,000 euros monthly until you're 60 based on what you're able to save right now. That's a total of 360,000 euros over the next 30 years just from contributions alone. Now you receive 10,000 euros as a gift and you're thinking about dollar cost averaging this comparatively large amount. But when you now put it into perspective, that's less than 3% of your lifetime contributions. Is it really worth obsessing over the perfect timing for 3% of your investment journey when perfect timing doesn't exist, you can't predict crashes anyway, and your time is valuable? I wish I had understood this perspective when I started out. When I started investing, I used to obsess over the perfect time to buy ETF shares. I looked at charts and the current price, listened to what stock market analysts were saying, and convinced myself that waiting a few weeks would probably let me buy in cheaper. And while it's completely normal to feel like waiting for the right moment or spreading out your investment over a few months makes sense, especially when you hear that valuations are high right now, specifically in the US, I'm so grateful that I don't waste mental energy on this stuff anymore. Here's what I learned the hard way. There were countless times where I ended up buying my ETFs at a higher price later on, precisely because I waited for that perfect moment that never came. While I was waiting, the market just kept rising. Does that sound familiar? Over the years, I finally managed to train myself to simply invest as soon as I have the money. Here's what my wife and I do nowadays. We invest a total of 1,500 euros at the start of each month via automated recurring investments into our global ETF, the accumulating Invesco FTSE World. The rest gets invested as soon as I get paid throughout the month, since I'm self-employed so my income is irregular. No checking charts, no market predictions, no second guessing. Whenever we have extra money to save beyond our emergency fund with 6 months of living expenses, we invest it immediately. It doesn't matter what the market is doing, and it doesn't matter what the news is trying to scare us with at each point in time. Our world ETFs have averaged 11.16% per year since 2017 with this simple strategy. So I feel like this approach has served us well so far. More importantly, it has freed up so much mental energy and time compared to constantly wondering about the right moment to invest, a moment that doesn't actually exist. Instead of spending hours looking at charts and reading predictions, we were able to focus on what actually moved the needle, earning more money while keeping our expenses in check, thus increasing our savings rate. But honestly, the biggest benefit is the peace of mind that comes from knowing that there's no point in worrying about something that you can't control, and you're much better off using the time and mental bandwidth you save on what really matters. In my case, that's more quality time with my wife and daughter. Now, I know what you're thinking, so let me quickly address the most common concerns I hear. What if the market takes a nosedive right after I invest? Market swings are only a problem if you need the money soon. And if you need the full amount soon, meaning within the next 3 to 5 years, you shouldn't be looking at the stock market. Put it in the high yield savings account or Euro money market ETF instead. But if your investment horizon is over 5 years, ideally 10 years or more, Short-term fluctuations are just noise in the long run. So far, every single crash in global stock market indexes has been followed by a recovery to new highs. While there are no guarantees, that's what over 100 years of stock market data shows us. But shouldn't I keep some cash for opportunities? What opportunities exactly? The crash you can't predict and which you'll likely be too scared to buy when it happens because you'll be waiting for even lower prices? All you know for sure is that your euros are losing purchasing power to inflation year after year. But we're at all-time highs right now. Yes, and so what? Since the stock market trends upwards over time, it's completely normal for it to reach new all-time highs regularly. In fact, when looking at the US S&P 500 index, you may be surprised to learn that returns have historically been better on average when investing at those levels compared to buying on all other days over 1 to 5 year periods. If you want to invest successfully long term, you need to get comfortable buying at record levels a lot of the time. That's just how growing markets work. Here's what I've realized after 8+ years of investing. Your long-term results depend far less on perfect market timing or portfolio optimization and much more on your ability to stick to a simple, repeatable strategy. When you invest immediately and automatically, for example using a recurring investment on Interactive Brokers a few days after you get paid, several powerful things happen. First, you remove emotions from investment decisions and can't talk yourself out of investing during scary news headlines. And trust me, there will always be scary headlines. Second, you maximize your time in the market and benefit from long-term compound growth. And third, you free up mental energy and time for what actually matters, like increasing your income, your savings rate, or the time you spend with your loved ones. The most successful investors I know didn't reach their early retirement number by timing the market. They followed a simple strategy and stuck to it during bull and bear markets, while focusing on what they could really control, finding ways to grow their income while resisting lifestyle inflation, ultimately helping them reach their goal faster. Even Warren Buffett didn't become rich by perfectly timing his purchases. He became rich by consistently buying great companies and holding them for decades. The same principle applies to us, regular investors in broad, low-cost ETFs. Look, I get it. The idea of investing a large lump sum all at once feels scary, especially when the future seems uncertain. But here's the thing. Based on historical data, you're statistically more likely to do better investing your money right away compared to spreading it out or waiting. As we discussed today, dollar cost averaging doesn't actually reduce your risk or protect you from crashes, even if it may feel that way. And remember, that lump sum you're worried about, it's likely only a small percentage of what you're able to invest throughout your entire life. Also, if there's one thing I can tell you for sure from my 8+ years of investing in ETFs so far, it's this. It never once felt like the perfect time to invest. There was always something different to worry about. Geopolitical tensions, inflation, interest rates, COVID, election outcomes, currency fluctuations, you name it. If you're waiting for the perfect moment where putting your money into the market feels easy and worry-free, I'm sorry to disappoint. That moment will never come. As the saying goes, the best time to invest was yesterday. The second best time is today. Of course, this doesn't mean you should be reckless. Make sure you have your emergency fund in place first, covering 3 to 6 months of living expenses, so you're covered in case you lose your job or your car breaks down. And make sure you're investing money you won't need for at least 5 to 10 years. But once the basics are covered, stop overthinking, have a simple strategy in place you can stick to long term, and focus on living your best life instead. As usual, you can find my favorite low-cost broker in Europe to buy ETFs link down below, which is a great way to support me if you'd like to. Now, I'd love to know in the comments below, do you prefer dollar or rather euro cost averaging a lump sum, or do you invest everything immediately? Please don't forget that none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful day, and until next time.